Good day and welcome to Mastek Limited Q4FY20 results conference call. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Ms. Asha Gupta from Christensen IR. Thank you, and over to you, ma'am.
Thanks, Aman. Good afternoon to all of you, and thanks for joining Q4FY20 results of Mastek. The results and presentation have already been mailed to you, and you can view that on our website www.mastek.com. To take us through the results today and to answer your questions, we have the top management of Mastek, represented by Mr. John Owen, Group CEO, and Mr. Abhishek Singh, Group CFO. Also today over the call, we have Mr. Umang Nahata and Mr. Rakesh Raman, co-founders of Evosys. Mr. John will start the call with brief overview of the year and the quarter gone past, which will be followed by Mr. Abhishek, who will be going into detailed financials, and Mr. Umang Nahata, who will share his experience with Mastek. We will then take the Q&A session. I would like to remind you that everything that is said on this call that reflects any outlook for the future or which can be construed as forward-looking statements must be viewed in conjunction with the risks and uncertainties that we face. These risks and uncertainties are included but not limited to what we have mentioned in the prospectus filed with SEBI and subsequent annual reports that you can find on our website. With that said, I now like to hand over the call to Mr. John. Over to you, sir.
Thank you, Asha. And to everyone, I hope everybody is safe and well in this lockdown period. Welcome to a belated earnings call for Mastek's Q4 fiscal 20 results. As always, it's a real pleasure to review our results with you, and this time we'll also present the full year performance for fiscal 20, which started with the first of many Brexit extensions through the year and ended with coronavirus global pandemic. So it's certainly been an interesting year. Due to lockdown, although we are in different locations, as always, I'm pleased to be joined by Abhishek, who will cover our financial performance. And I'm also pleased to introduce and welcome to their first earnings calls the former promoters of Evosys, Umang Nahata and Rakesh Raman, who are now significant shareholders in Mastek. As we said, Umang will share his perspectives on the early days of the acquisition and how it's been received by his Evolite employees, who are now Mastekeers, his customers, and his partners. Probably more importantly, in the shadow of COVID-19, is the adjusted market outlook we have for ERP cloud migration, which is really exciting. Also, the new incremental opportunities we all see for Evosys now that it is part of a larger Mastek family. We all think there's a real opportunity to make 1 + 1 = 3, which is our ultimate goal. Before I give a business update, let me first apologise for the delay in announcing our results and the inconvenience this will have caused. I appreciate this will have led to many frustrations for you at absolutely the wrong time, as the general market confidence evaporated and we slid into a global pandemic. It seems hard to believe that only in February our stock markets were at historic highs, and today we're now staring in the face of probably the deepest recession in history. Hopefully today we'll be able to provide those much needed KPIs that give you more clarity and confidence in where we are, what we've done, and where we are going. From the data already provided, I hope you now recognise that Mastek is a more resilient business. Mastek does not operate in a vacuum, and like any other company, it cannot fully insulate itself from the impact of COVID. However, I do believe we can significantly mitigate the downsides better than any of our peers. Mastek's resilience is primarily driven by 4 factors. One is we have strong market fundamentals. We have a resilient market segment in the UK public sector and the ERP cloud migration, which we expect to remain solid growth engines through the whole of fiscal 21. I know last year we may have sometimes been viewed as having an unhealthy customer concentration around the UK public sector. However, today this must be seen as a real key asset. A major customer that continues to grow with an excellent payment record is invaluable to anchor stability. Now add to that to this stability the dynamic cloud migration business of Evasys, and we now have another growth engine to fuel our growth and effectively fire Mastek on more cylinders through this crisis. The second point of differentiation is our organizational speed and agility. It's worth remembering we've operated with a distributed and empowered workforce since the introduction of Mastek 4.0 back in 2016. As we move to a work from home model, this culture has certainly helped us maintain the goodwill and ownership of the business outcome at the operating level, which is now a critical success factor to our productivity, our innovation, and our business continuity with our customers. I think another aspect is our management experience. Last year, we had the Brexit uncertainty and we managed that. We demonstrated our ability to protect the quality of earnings with a softer revenue performance. Our ability to strip out overheads without damaging our front-end productivity, quality, and customer relationship will remain an invaluable capability through this new crisis. And finally, I think we have strong financial management, and we have and we will continue to generate strong cash flow, which will continue into fiscal 21. And our operating footprint, we have the financial strength and agility to weather this storm. I know the COVID crisis quite rightly dominates every conversation at the moment. However, it's still worth remembering that this was a quarter when we originally intended to celebrate the progress Mastek has made over the last 3 years under the disciplined strategy of Vision 2020. Today, we exit the Vision 2020 phase with a very solid platform for growth. Revenues at historic heights, with more to come as we layer in the full impact of Evasys in outer quarters. A more diverse and balanced business, improved business controls, better forecast predictability, and the financial health to execute the plans. And finally, a robust management team that focuses on delivering outcomes, not excuses. It is these attributes that will now help us successfully navigate the current crisis and thrive. Our intent is for this crisis to have a shallower impact on Mastek and our recovery to be faster, as this will allow us to expand quicker once the market normality is established. A landscape, I have to say, I think will look very different post-COVID. Enough context setting, let's review Q4 performance. As previously stated, we described Q3 as a turning point and we maintain that position. Overall, Q4 delivered to expectations with revenues rising 38% quarter on quarter in constant currency, driven by a strong return to growth from the UK and the partial revenue consolidation from Evasys. With political clarity on Brexit and the UK business returned to a solid 7% growth quarter on quarter, and our public sector remains the powerhouse. And despite the Brexit headwinds we discussed, it grew 12% year on year. We still experience challenges with our US operations, which was particularly badly impacted by its exposure to the retail sector and then compounded by the effects of COVID, with orders delayed, projects deferred, and ultimately customer ramp downs. These events immediately triggered a further reduction in our capacity and cost structure. Our working assumption going forward is that the US market will recover slower than our other units across Mastek, where we are still seeing strong traction in the short term. The addition of Evasys will certainly help will provide some much welcome critical mass to our US operations, and although both operations could be described as in their nascent stage, we do see some encouraging signs and expect gradual improvements in both revenues and earnings from this geography in the second half of fiscal 21. I'm extremely pleased we continue to sustain our quality of earnings drive, and in Q4 we delivered a solid EBITDA improvement performance at 17.3%. This is a strong performance when you also layer in some of the non-recurring costs of the M&A transaction fees, writing off some bad debts, and upgrading our cybersecurity infrastructure to accommodate a widespread working from home model. This is encouraging as we deliver a more revenue line and we better leverage our fixed costs and SG&A, which will become more important as we need to absorb the natural price pressure that will result from a contracting labour market. Sustaining margin improvement longer term will require a more accelerated adoption of new delivery models and technologies such as automation. Operating EBITDA increased 73%, driven primarily by the increased revenue, some strong cost management, and our active management of the COVID crisis. To be truthful, at the start of the crisis back in January, nobody, especially me, envisaged we would be where we are today, with approximately a third of the global population in lockdown and economies coming to an emergency stop. I think where we benefited at Mastek was that we did classify early on that coronavirus was a potential enterprise risk to the company. This meant we mobilized a cross-functional team to look at the potential impact, our response, and align our resources accordingly. This pre-event planning and mindset had allowed us to make informed decisions way ahead of the curve and be proactive with our customers. This enabled us to respond faster and more efficiently than many of our peers who saw this as a quick V-shaped impact and immediate recovery, which obviously it has not been. This active management allowed all our customers to execute their business continuity plans smoothly, and we enabled us to transition within 3 weeks both Mastek and Evasys' full operating model from a previously 95% office-based delivery model to today 100% work from home operating model. This plan had 3 priorities that shaped and will continue to shape our thinking. Number 1, we protect our people. That's both their physical health, their mental health, and their economic well-being. Secondly, we protect the business. So we have moved to work from home. We've reconfigured some of our customer deliverables, and we've got secure relationships with our customers. We've invested in cybersecurity. And the third element to balance out is we also protect our company. So you'll see the cash collection improvement. We stopped at discretionary spending, and we quickly right-sized the business for the new economic reality because the existing capacity curve was way ahead of the projected demand curve. We completed the work just before the UK lockdown hit on March the 23rd, and that also included our secure delivery for the UK government customer, which has been a critical area for us. Going back to how important Mastek 4.0 culture is, this is what an agile, empowered, and customer-centric business can do with dedicated and collaborative employees. And I thank our loyal customers, my fantastic employees, for delivering this Herculean outcome. We literally transitioned our business overnight, and we did not drop a heartbeat with our customers on quality, velocity, or productivity. I do want to especially thank all 3,500 employees for allowing Mastek to literally move into their homes. Without their support and ongoing goodwill, our business would have been more damaged. But as you can see from the results, in the short term, we've responded extremely well. Let me give you some commentary on what the future is likely to look like. Trading in January and February was strong, but by the middle of March, the depth of the crisis seemed to crystallize, and it became clear our original fiscal 21 growth plans and aspirations would need to quickly adapt. We immediately shifted gears to implement our tactical strategy across the group called Cut and Grow. Necessity truly is the mother of invention, and by the end of March, we had already removed all discretionary spending, initiated some cash conservation initiatives like deferring the annual bonuses. The executive team took a voluntary pay reduction, and we renegotiated terms with our major suppliers. Please remember, this work was also being done when we were also converting the whole of our operation to work from home. Let me expand a little on the cut and growth strategy that replaces Vision 2020 in the short term. The working hypothesis is that the most severe impacts of COVID will be front-loaded into the first half of fiscal 21. Stability hopefully coming around Q3 and gradual market improvement in Q4. The market has certainly contracted and continues to be fragile. We are assuming it will be at least a good few quarters before the general economic confidence returns. So effective immediately, we needed to rebalance our business to realign our capacity with the new realities of a new demand curve. Going into fiscal 21, we were planning to invest approximately 5% per quarter in additional capacity and grow into that new capacity backed by a solid pipeline. We have now reversed that assumption, which means we immediately stopped hiring, we deferred new starters in the system, we removed external contractors, we placed non-productive staff on furlough, and we actively managed our bench and removed any investments where we didn't see a short-term return. As market confidence further eroded in April and May, we've already shared with our people that there will be no annual pay hike this year and potentially job cuts if we do not rebalance fast enough. This is extremely painful, but unfortunately necessary. Our current plans suggest that we will have our capacity and demand fully aligned in Q2, which would put us in great shape to move forwards. Cut and grow is essentially a two-sided coin. Side one is to reduce our costs and our capacity quickly and repurpose those resources into side two, which accelerates the demand side, where we're currently seeing a robust pipeline from our two growth engines of the UK public sector and our Evasys cloud migration business. The UK public sector is attractive because this is our core and is also counter-cyclical in the market. The UK government needs to accelerate its digital transformation to help now save even more money and pay for the furlough measures it's taken over the last few months. So let's not forget, we also have a Brexit agenda to deliver later this year. So the application infrastructure still needs to be built. Mastek is already recognised as a trusted delivery partner, and so we need to increase our coverage, broaden our base, and leverage this position. The Evasys portfolio is also very attractive because this crisis has brought home the need for enterprises to have a more modern, economic, secure, and resilient application infrastructure that can be accessed remotely. This means that cloud migration of legacy applications continues to enjoy strong pull factors. Couple that with the old on-premises platforms being sunsetted by both the market leaders of Oracle and SAP means the market demand remains robust. In both portfolios, UK Public and Cloud, we have seen increased pipeline activity in Q1, which gives us optimism our COVID-focused plan is executable. Let me now move to the acquisition of Evasys and how the transition has been going. I'll let Umang provide his own perspectives later, but from my perspective, I'm really pleased to have the Evasys business as part of Mastek. The whole migration story will significantly help us drive growth through this COVID crisis, and we must fully exploit the pull factors from cloud migration. Personally, I'm also very pleased to have Umang and his team as part of the management, where they bring a new perspective, additional talent, and raw ambition. You will see from the presentation material that Evasys has brought strong diversification to Mastek, which mitigates the challenges from the last few years being overexposed in the UK market. Evasys brings another growth engine to Mastek Group, and for the first time, Mastek has a strong, repeatable customer acquisition engine in a totally complementary and growing market space of ERP cloud. This customer acquisition engine provides a fantastic platform for future cross-sell opportunities. I'm pleased to report a good start to the transition. Both Evasys and Mastek are performing well independently, or as I've previously stated, column 3 and column 1 sales motions remain intact and on track. We're keen to ensure the acquisition doesn't become a distraction to the core performance of each unit, and we've reported separately to help you provide this transparency. In addition, we're also building good pipeline in column 2, the cross-sell upside, and I'm pleased to report we've already secured our first joint customer win in the UK with a $4 million TCV. As the saying goes, one swallow does not make a summer. However, encouragingly, we are starting to see similar projects in all regions appearing in the pipeline. I think it's also important to recognise the impact of Evasys of now being in the larger Mastek. We've been able to win larger deals, open up new partnership channels. Evasys is now recognised as a next-generation services partner, which will act as a positive disruptor, similar to the way Mastek drove positive disruption in the UK public sector 4 years ago. The acquisition of Evasys was also intended to add a complementary market segment to Mastek. Our customers are starting to recognise the benefits of Mastek being able to support them as a digital partner for life. I'm also pleased that Gartner have recognised the Evasys in their Magic Quadrant this year, which further supports our credibility and will further support our sales efforts. It's no secret 70% of acquisitions fail, and as I said before, I fully appreciate and recognise the concerns many investors will have had on the size and timing of this deal. These concerns would have only been amplified under the COVID and subsequent information vacuum. I now hope the results demonstrate some early proof points to help reassure you. Today, we operate a more diversified Mastek, and with Umang and Rakesh settling into the management team, I hope this gives you increased confidence that this acquisition will fall into the 30% of successes. I think this provides an appropriate segue into quantifying the progress Mastek has made over the last 3 years under Vision 2020, which culminated in the divestment of non-core assets in the likes of Majesco and the reinvestment of that cash into cash-generative assets like Evasys. Since we started in Q3 fiscal 17, Mastek's revenues have strengthened 167%, our earnings have been improved by 322%, and our order book has improved by 250%. Our people capacity has increased by over 2,000, and our customer base now stands at over 400, whereas when we started, we had only 91. So overall, I hope you now see a more balanced, resilient, cash-generative Mastek with a clear purpose and direction of travel. Despite the current challenges, we're very well placed to continue our positive progress, build a sustainable company, and deliver value creation for all Mastek stakeholders. So in summary, I'm pleased with our performance and remain cautiously optimistic for the future. Our mindset is correct, and we have the clarity in following a short-term cut and grow plan, which should mitigate the worst impacts of this COVID crisis. The impact of COVID on Mastek is intended to be shallower than our peers and the recovery faster. External shocks such as COVID creates winners and losers. Our job is to make Mastek a winner, and I hope from our results, our decision making and our focus, you share our belief that this is a realistic outcome. I'll now hand over to Abhishek to take us through the financial breakdown and provide more context, and then Umang will share his observations, and we're then happy to take your questions. Abhishek.
Thank you, John. Warm welcome to everyone on this call. I'm going to share with you the highlights of our financial performance for this quarter as well as fiscal 20. You have the deck circulated ahead of this call, which contains the details of our financial performance. So I'm going to focus on the snippets of our performance. Having said that, I would like to start with a bit of a recap. A lot has been articulated by John and published by us in our narratives. However, it's important to note that we started the fiscal 20 with the challenge in our major markets, UK and US. While UK had the overhang of Brexit coupled with political uncertainty, and all of that had a bearing on both our private and public sector businesses. US business had just completed a restructuring, and we were in the process of appointing a new management team in the early part of the financial year. So we started the financial year with these backdrops, and in that light, most of our performances have to be looked upon. That said, it didn't prevent us from driving our strategic agenda. We continued to invest in our management team and solidify our delivery and sales capability. If you recollect, we had appointed Dennis Padman as head of delivery. In the early part of the financial year, we made investments in the sales roles and the head of America's role across US, UK, and India. All of this was done in parallel and with the agendas that we had, that is monetize our non-core assets and bring it back into the business in the form of making an acquisition. You know, and you've noted that we've sold 60% of our stake in Majesco, and rest 40% is again up for grabs, and we are pursuing that. We continue to scout for inorganic opportunities, which culminated into acquisition of Evasys in February 2020. And all of this was happening, which is paused to catch our breath in February, when one of the largest health crises in the form of COVID-19 surfaced, and which eventually culminated into a global economic crisis. So organizations and countries have all been dealing with this phenomena ever since, and everyone is working to adopt and adapt themselves to this challenge, service their customer, and essentially survive. And at Mastek, we are no different. So having said that, the austere year that started with Brexit uncertainties actually helped us in being a little bit better prepared than anyone else, because we have been dealing with the cost management, the business efficiencies, and cash focus right from the beginning of the financial year, not necessarily triggered by the COVID initiative. And as a result, you will see the financial performance, which reflects some serious toil and maneuvering of the business in difficult times, which has resulted in protection of our employees, servicing our customers, and in essence, protecting the value for our shareholders. I'll start the financial commentary with Q4 fiscal 20 highlights. and I would like the audience to note that quarter has had the impact of business consolidation of Middle East business of Eversys for 1 month and the demerged portion of the business for 2 months. If I look at Q4FY20, our total income stood at 354.2 crore, and EBITDA, I beg your pardon, I seem to have jumbled up the numbers. Q4 fiscal 20, our total income stood at 336.7 crore, which was up 38% quarter on quarter. Our operating EBITDA stood at 58.2 crore, which was up 73% quarter on quarter, and PAT stood at 38.9 crore, which was up almost 50% quarter on quarter. If I move on to some of the key metrics of Q4 FY20, I'd like to mention that cash and cash equivalent continue to be the focus, and it stood at 414.7 crore. And net of debt, the cash stood at 81 crore. The bad debt phenomena continued to be accelerated in the quarter. US geography experienced a very significant impact of that. A lot of it accelerated by COVID. We had to make provisions for 12.5 crore for the potential bad debt that we are staring at. However, we continue to be engaged with the customers and try to kind of collect it feverishly to ensure that these phenomena have minimal impact on the business. Looking at our order backlog, it stood at 785 crore for the consolidated business of Mastek, organic as well as inorganic business. We added 24 new customers during the quarter, which was evenly spread across organic and inorganic business. If I move on to fiscal 20, just as a snapshot view, our total income stood at 1,112.8 crore, up 5.2% year on year. EBITDA stood at 196.7 crore, which was up 25.8%, and PAT stood at 113.8 crore versus 101.5 crore in the last year. Now, the biggest testament of our cash focus is essentially the free cash flow generation. And if you look at the numbers, we generated around 168 crore in free cash, vis-a-vis 60 crore that we generated in fiscal 90. And this is what helped us prevent any possible delinquencies that we experienced in each of the geographies at a heightened rate, though UK was a lot more insulated than US and India. If you look at fiscal 20 in totality, we had to make provisions for 18.8 crore in bad debt. The big one of that was Cox & Kings bankruptcy in India. So, long story short, the way we have looked at it is it was very clear that the year started on challenging note. Cash management, cost management, efficiency drivers were the core focus. And based on that, we have been able to deliver the financial performance, yet driving the strategic objective of monetizing the non-core assets and plowing it back into the business in the form of Eversys acquisition. I'll take a few minutes to just add some colors for various geographies, whatever we have experienced, and that will give the audience better insight into what Mastek has dealt with in each of the geographies. So if you look at UK, as John alluded, the year started with the Brexit uncertainty, and which had some bearing on the revenue, as well as the behavior exuded by public and private sector customers. However, it is important to note that despite all of these uncertainties, the UK public sector grew by 6% year on year. However, the story on the private sector was a lot different, and it grew by almost 14% on a year-on-year basis, because they were looking at conserving cash, and they were looking at certainty before they committed to the discretionary spend. The fact that our public sector continues to be robust and provides with a good visibility of opportunities, we have augmented our sales team further with the appointment of Steve Latchin as Executive Director of UK Government Business. He brings in a significant experience in UK public sector, and he's also an ex-Mastek here. So it's an amazing combination that we have had in his candidature, and he's leading our initiatives with the UK public sector. If I move on to US geography, the geography started very well with H1 growing nicely over the prior year, that is fiscal 90. However, H2 was marred by negative seasonality in Q3, and it was further impacted by COVID phenomena in Q4, where a lot of our engagements were cancelled by the customer, proof of concepts not honored, and essentially the request from a lot of our customers to move the business to the latter part of the year for conversations. As a result, the business grew by 10% on a year-on-year basis. However, the new sales team under Raman's leadership is in place, and we now see a very structured approach to the U.S. market, which gives us confidence that we'll be able to make good on our investments and see the growth in coming times. Some data points on the retail industry in the U.S., given the fact that 100% of the Mastek business in digital commerce space is retail sector focused. You'll be amazed to know that in the calendar year 2019, 9,302 U.S. retailers closed their physical stores. This was almost a 60% jump from 2018. But in contrast, the other data point that gives us a lot of confidence is that the e-commerce sales are expected to grow in the range of 12 to 15%, which means that there are a lot more of application development and there's a lot more of IT services that are needed to augment those capabilities of brick and mortar retailers to move towards e-commerce. We also bolstered our offering by furthering our alliance and partnership. Two of the notable ones were Commerce 360 and Scava. And pandemic actually has offered opportunities of vendor consolidation as well. We have seen that a couple of our top customers have looked at this opportunity to consolidate a lot of fringe roles in the managed services fashion, and we have responded to a few of those opportunities as we speak. We'd also like to notify that to service our customer better, we opened our new Canadian entity, Mastek Digital Inc. in Canada, and we have already landed our first SOW in the geography. Moving to India, the story in Indian business is a mixed bag. While we appointed a sales head in October last year, we have continued our focus on reducing the footprint with the government business and expand our footprint with the private sector customer, and we have had some good results and good traction coming in from the private sector customers. However, the biggest event for the geography was the bankruptcy of Cox & Kings, which was also the largest customer in the sector. I'd like to briefly touch upon our Eversys acquisition. A lot has been written, a lot has been shared by John as well, and I know that Umang would share his details. But in the first 60 to 90 days, what we see is that this is a very resilient business, and it has got a fundamental demand coming from its customers. Even amidst the pandemic, we have seen demand there, and as a result, it gives us the confidence that the existing customer base that it brings in and the capability that Mastek brings onto the Eversys cloud migration ERP implementation can create a new gen company which can service the pent-up demand that's there in the sector. So we feel very, very optimistic and confident about it. And last but not the least is COVID. A lot has already been again said about COVID, but I would like to reiterate that as an organization, we are hawkishly focused on our employee safety, augmentation of IT infrastructure and cyber security, because remote working brings its own set of challenges. All our employees are safe and in their home. In the first 30 days, we had practically 24,000 plus meetings hosted over MS Teams and WebEx. And employees continue to be very well engaged within their own teams and with the organization and the leadership to ensure that we have good employee engagement and we are looking at their health and safety while we are supporting our customers globally. With that, I'd like to hand it over to Umang for his comments, and which will then be followed by Q&A. Umang, over to you.
Thank you, Abhishek. Hi, everyone. So this is my first call on an investor analyst call. So I'm very, very excited about it. I'll start by giving a little more background about how do we and our side of the team Eversys, Israelites and our customers and partners, how is our feeling around the merger and acquisition that has happened. So I think first thing that is quite clear is the business opportunity for which this transaction was done is very, very clear. And I think that's more than half the battle won there if you have a clear vision going forward. So what we're trying to do here is build a next generation IT service provider which looks at delivering tangible value to our customers by delivering modern digital technology. So there are three key things, right? So next generation, delivering tangible value and using modern technology. And that's what the combination really brings in as a key focus that it would love to deliver. From a Evolite point of view, I mean, this is something that we clearly, all of us understand since the outcome and the objective is so clear. So the discussion with the team and the sentiments back to the entire Evolites was very, very positive. We all understood what we are trying to do here, and we all are completely in sync with that approach. From Evosys customer standpoint, again, Evosys has been a loyal and long-term partner for many of our customers. We literally have one of the largest install base of Oracle Cloud customers with Evosys. And I think what they see with us here is an opportunity of not just continue working with us on our Oracle side, but looking at us as a partner who could now bring a much more holistic digitization approach to them. So not just on the back office systems that we were really good at, but now to look at the back office, front office, and everything together around it. So that's a overall plus, and we've seen lots of positive customer emails from all across the world. From an Oracle relationship point of view, again, I think it's a very, very positive side for Oracle. They saw us as one of their top partners in the Oracle application space on the cloud application side, SaaS. Now with Mastek, I think we have a much stronger technology partnership also that we can really grow, and that makes us a much more holistic partner, which can cover not just apps but technology equally well. So I think all in all the three areas, key areas from an employee, customers, and partnership standpoint, it's a very positive and much more well-directed move that we have. We all know what is the goal and the vision that we want to achieve, and therefore we have hit the ground running, literally. As you can see, we've already closed our first transaction together. There's been a lot of other integration aspects that have moved very, very fast. From the experience of being a marketer over the last few weeks, I'll give an interesting analogy. So when we were doing the transaction, I was given the advice that this is like a marriage. So now I feel, although it was an arranged marriage, but it always felt like love. Because, it seems like we have known each other for a long time. We have been, that's the kind of transparency that we're sharing in the integration discussions. We have, very, very welcoming in terms of ideas, opinions, and advice on each other. Very, very quickly, the organizations are learning and sharing and giving feedback to the teams. We are working on various areas of business together already. And I think jointly crafting our way up into the vision that we have and trying to create a next generation IT company together. A quick view on our business impact from cloud and how Q4 was and how things moved there. So COVID clearly, as we all know, has been the biggest economic shock that we've all had. And initially, like John said, we all had the feeling maybe is this the knee-jerk that is going to bring us all down or what? But I think as we grow steady and we've all learned to deal with it, I think we're all in a much better position. So has been our customers, employees, and the market in general. And everybody seems to have learned to adopt. So our business continues to be very resilient as we move forward. We've had more than 90% of our projects continue, and some of the ones which were closer to go live have deferred it a little, but none of the customers have dropped off or canceled their business. 100% of the Evosys team has moved to a remote working environment. Also, the new order book and pipeline continues to flow in. So Oracle recently closed its Q4 at the end of May, and we had a Q4 which was better than the Q4 that we had last year. So we continue to have new customers flowing. We have more than 30 customers logos that we signed in this quarter also, and various transactions which had multi-million dollar values in order book. Going forward, I think on the cloud business side, with COVID, I think it's an opportunity in disguise for us as an organization. Digitization or cloud or automation has always been on the agenda of most of the companies. However, I think this is going to push that agenda much more forward, much more ahead in terms of the list that the clients had. And for example, all the customers who have already moved to a cloud platform, I think are finding it much more easier to operate their business than the ones who are in the midst of transition or are thinking of transition. And now I think everybody is going to move around looking at that automation in a hurry, and which is a really big and important opportunity for us as we try to build an environment which, where you can work remotely, have a much, secured environment which takes the latest and the best of technology, automation, all of it together, and provides an environment that is much more safe and secure. So I think it is going to become a much more business essential item than a good to have kind of initiative that was there 3 months back maybe. On the Oracle's business side also, I think Oracle continues to lead the market as far as the cloud ERP is concerned. They are very strongly catching up on the cloud HCM and the other cloud products. So as the market starts looking at a much more holistic cloud platform, one which can really solve their end-to-end cloud approach, right from ERP to supply chain to HCM to CX to technology to database. I think Oracle is the solution. We are the only ones that have a end-to-end footprint here, and which is very well recognized by most of the analyst reports that you look at. So Oracle on almost all their pillars are recognized as the leading partner for Oracle Cloud. On Evosys side, we also think that our alignment with Oracle is really working well. They see us as their partner of choice for transitioning on-premise business to cloud. We have built some really strong assets that allow us to work in that direction. So we have an asset called Evosys Glide, which has three strong flavors. It has an Evosys Glide for e-business suite. It has an Evosys Glide for SAP, and an Evosys Glide for PeopleSoft. It's an accelerator that allows us to migrate customers on these three legacy applications to Oracle Cloud platform. We've seen extremely good traction. We've had more than 90 customers that have already migrated from on-premise to cloud using the platform that we have. And the results have been phenomenal. So with the use of the platform and going after the direct market that we are really looking at, which is not just the Oracle install base, but also the SAP and PeopleSoft install base, I think the market opportunity is phenomenal that we're looking out for. So it's only about our capability to deliver and grow is going to be the constraint that we would have that we have to look out for. So I think all in all, we are seeing a really good Q4. We are seeing pipe continuously come in. We're seeing order books continue to come in. We're seeing lots of go lives that have happened over the last quarter, and we continue to see many more customer success stories that would come in. So with that background in mind, I think it's been a phenomenal experience. The last few weeks have been really encouraging, and we look forward to building a much stronger joint company that could expand and offer a much larger solution to our customers and a much larger footprint for Oracle in general. So thank you, and that's a brief overview of my side. Back to you.
Sure. Should we open the line for Q&A?
Yes, please.
Yeah. Thank you very much. Ladies and gentlemen, we will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on the touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets for asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. Anyone who wishes to ask a question at this time, they may please press star and 1. The first question is from the line of Nirmal Bari from Samiksha Capital. Please go ahead.
Hello. Hello.
Hi, Nirmal. Go ahead, please.
Yeah, thanks for taking my question. My first question is on the Evosys revenue, which was reported in the presentation that Evosys contribution for the current quarter is about 87 crores, of which 24 crores would be from Middle East. So if you can give a breakup of rest of the geographical revenue for that.
Thank you, Nirmal. So the remaining of the revenue that you're looking at is coming from the UK, US, Australia, New Zealand, and Indian market, to name a few. From a revenue point of view, obviously UK and European market contribute a lot more compared to US market and the Australia and New Zealand market. So that's where the rest of the revenues are coming from.
Yeah, so that was my second question actually. What would be the organic growth rate in UK for us in the current quarter, and because there's a jump and some of that is coming from Evosys.
Okay. So you're looking at Mastek in terms of the core services. Yeah. So we have experienced 7%, 6 to 7% quarter-on-quarter growth in the geography.
Okay. The second question was on the government services. So I believe you have started classifying health as NHS as a separate health vertical. Is that understanding correct?
NHS as well as the healthcare customers that comes as part of the Eversys acquisition. We have got a decent footprint across the world as part of Eversys service offerings in the healthcare customers. So yes, we have picked up NHS as well as all the other healthcare customers, which we show it separately.
Thank you, Mr. Bali. Request you to join the question queue for any follow-up. Also, participants are requested to limit their question to 2 per participant. If time permits, you may join the question queue for any follow-up. Thank you. The next question is from the line of Mohit Jain from Anand Rathi. Please go ahead.
Hi, sir. First is on the outlook for June quarter for the 3 entities, like UK business is back to growth, but order book is sort of falling. US, I am assuming the hit will be more in 1Q, because last quarter you only had March where the shutdown impacted retailers. And third is on Evosys. Also, if you could add Evosys FY20 numbers in dollar terms.
So Mohit, the first question on the US business, actually we experienced significant impact in Q4. Q4 to Q1, we don't see any significant movement either way. I would say that what you have is a reasonable representation. Your second question was on UK. I missed that. What was about UK? Hello?
Yeah. Sir, UK, I was asking what is your outlook given that order book is coming off, but Brexit is behind us. What is your overall outlook in the UK region?
Okay. Mohit, I'll take that one up. I think the order book, at the moment, there is a deferral. So we are getting a lot of extension orders for two quarters as they basically renew some of their contracts. So the order cover isn't as strong as it should be, but the government particularly aren't giving out longer term contracts. They're just bridging at the moment. We expect that to be corrected over probably the next 2 quarters. I think the UK government generally are looking at going back to austerity. Although they released their spending review budgets for fiscal 19 and 20 in January, they've reversed those already under about 15 to 20% reduction. So I think governments are adapting and sort of trying to absorb that shock and recut their plans. But if I look at the pipeline coming through probably the next quarter, it is robust from a pipeline perspective. I think we've just got to be cautious because I do see things being maybe moved to the right a little from an order book perspective, which means that we get a smaller order book just to bridge that gap, if that makes sense. So the market is robust in the public sector. I think the private sector is troubled, and I think we'll see a lot more softness as we come out of Brexit, because I think when furlough starts to be reversed, I think the true unemployment figures in the UK will start to be reflected. But I think we can offset that with a strong public sector order book.
So you are not anticipating a significant decline in the June quarter, given your order backlog and everything?
I think we're looking at stability is probably the right word, and stability has plus or minus, but we're not falling off a ledge like lots of people. If you were in, say, hospitality or transportation, I mean that's a desperate sector to be part of. We're not in that situation by any stretch. So stability would be the word.
Yeah. Lastly, on Evosys, how has the business moved on a QQ, and what were FY20 numbers from a YOY comparison perspective?
Right. So Mohit, in terms of the business growth, they have seen Evosys has experienced a 10 to 12% organic revenue growth year on year in fiscal 20 over fiscal 19, and on a normalized basis, sparing all the acquisition and transaction related expenses, we are looking at a 18 to 20% EBITDA profile of the business.
Okay, and any deterioration from last quarter to this quarter? How much was the impact? Anything you are anticipating in 1Q?
As I shared earlier, the business has had some impacts for sure, where the customers weren't taking the delivery or they were deferring the go lives. And same thing on the sales side, where they had relatively tepid last 10 to 15 days of the quarter. But having said that, Oracle's favorable seasonality is the month of May, wherein they run from June to May cycle. So we are in one of the better quarters, and we expect the momentum to continue.
All right, sir. Thank you. That's all from my side. All the best.
Thank you. The next question is from the line of Madhu Babu from Centrum Broking. Please go ahead.
Sir, considering this is an exceptional situation, most of the companies are giving a kind of guidance for 1Q. So could you give us a view on how much the decline, because larger vendors are saying 5 to 7% kind of QOQ decline in revenues. So for us, how it is going to shape up? Because I guess Evosys will have an incremental revenue for the next quarter. So could you quantify how much incremental from Evosys will come and how the overall portfolio will span out in 1Q?
So Madhu, the obvious benefit would be of the full quarter consolidation. A part of the business was consolidated for 2 months. That was the demerged part of the business. The Middle East business was done only for a month, so we'll get a full 3-month impact there. So those would be the natural augmentation on the business. On the core services side, we expect a stable quarter, as John alluded to it. So all in, it will obviously be positive and higher from the levels that we are at.
So that incremental revenue from Evosys on a steady state, how much it will be, like 4-5 million quarter on quarter, because of the full impact of consolidation? Because 12 million we had this quarter, and if it's a 68 million kind of annual, it's almost like 17 million quarterly run rate. So
you
can
already
you say
reduced that. You have already reduced that.
Yeah.
You're fairly close.
Okay, so just last one on the share count. I mean, we have to factor the dilution as well, right? I mean, in terms of for FY21, the fresh share 28.4 million kind of shares. Post dilution.
Yeah, that is subject to NCLT. Yeah, once the NCLT approval comes in, those shares would be issued.
Okay, sir. Thanks.
Yeah.
Thank you. The next question is from the line of Sachin Kasera from Swan Investments. Please go ahead.
Yeah, hello. On this Evosys, from what I understand, when you check the presentation at the time of acquisition, they were running at 20 to 23% EBITDA margin. So in FY19 and LTM what you had shared. So in FY20, is there some sort of correction in EBITDA margin that Evosys has seen, or?
That's right, Sachin. There is a significant investment made in the trainee workforce for the fulfillment of the upcoming project. So this is a business where you hire the freshers and put them through a 3 to 4 month training process and then 2 month on-job training, where they are not necessarily billable. So the growth that we are seeing, a part of that cost was already taken in the month of January, early January. And some of that will impact us in fiscal 21 as well, as the trainees are going through the training process. But it is part of the business growth cost rather than any kind of quality of earning dilution, Sachin.
Sure. Secondly, on the US business, excluding Evosys, if we see the core business of Mastek, I think we had a sharp correction this quarter. So, we were going through a rough patch there, then 2-3 quarters we saw some improvement. Again, this quarter again there's a correction. So what is the roadmap out there? Are we looking in terms of some sort of a call to be taken and, closing it down, or is there again some more strategy to again, get it back on road track? Can you just help on that?
So I think, Sachin, I'll try and help you on that. That operation came via an acquisition, and it was heavily dominated by the retail space. And the retail has been a roller coaster, and I fully respect. We've been up, we're not out of the woods. I think if I look at it and go back to a little bit that Umang talked about, if I look at it in retail, Oracle probably is competitive in the retail with Oracle Cloud Commerce. But in the ERP space, they're absolutely a market leader. And I think ERP is their core, it's their core of their business. So I think the combined assets of Oracle, of Evosys and Mastek will start to give us a better platform. But it's more about we've stabilized, it's not a drain, We're taking corrective action. I would expect if I look at some of the projects over the next 2 quarters, I'm conscious I've said this before, so it comes with a health warning. I feel we've got some stability. We've certainly upgraded the caliber of the sales organization, and we're starting to see traction with the pipeline, and we're starting to win some new logos. But I think it's wait and see, not we need to either knee-jerk into doing something and retrench, or we're going to expand massively. It's a wait, see, build the traction, and then start to break out from that smaller base.
Sure. So just one last question on new order wins. So from what I understand, we had invested substantial resources in terms of, trying to bid for the larger order wins. And I think that new leadership team has spent now some time at the Mastek. So are we seeing some signs of participating in some of the larger sized order books, and we could see some success maybe Q3 or Q4 onwards? What's your sense on that?
Yeah, I would share that sort of timing of Q3, Q4. I think they'll come out of the UK and the public sector side. I think with respect, trying to compete for new logos in the private sector is difficult at the moment, particularly when you can't go and meet people. So we're all in sort of lockdown. So I think there is a natural retrenchment to your existing supplier base. But I do see if I look at the pipeline, the deal flow coming through the public sector and health is, we're broadening our account base outside the Home Office, the health sector, the NHS and the MOD. So we're broadening that base, and as you say, the average order value is getting higher as well. So, but I'd expect those to start to flow through Q3, Q4.
Thanks, and all the best.